What about the fundamental setup? Let's take it across to Nikunj. He's got Ravi Dharamshi from ValueQuest Investment Advisors joining him on the show. Nikunj, take it away.
2019, so far so good. We've been off to a good start. The concerns which haunted us post-Christmas Eve, both at a global level and at a local level, looks like they're getting addressed. For the moment, the fear of trade war, it's on the back seat. For the moment, volatility in crude and the currency seems to be subsiding, and flows, which are often the most important relevant factor to gauge the short-term and the medium-term market direction, they are looking stable. But after the twists and turns of 2018, are we in for a stable 2019? The script of how Indian markets moved in 2018 was a function of macros and only macros. Will classic, old-fashioned stock picking make a comeback? Let's discuss that on today's edition of Market Maker with one classic stock picker who believes in principles, his solid foundation of understanding markets and his assessment of various sectors and companies. Ravi Dharamshi, ValueQuest is back. Ravi, fantastic to have you back. It is still Jan, so it's not time out to wish Happy New Year.
Happy New Year to you as well. Yeah, I mean, we are just happy that 2018 is over.
Well begun is half done?
Yeah.
Or this is just the beginner's luck?
No, I think first of all, our tribute to John Bogle. I think there's a lot of contribution to the fund management industry, and one has to recognize that. Coming back to 2019, I think we really went through a rough period in 2018, especially if you are somebody managing a mid-cap concentrated strategy focused on Indian mid-cap, small-cap. So valuations are now in your favor, and some of the things that were really bothering, like the crude or the interest rates going higher, I think those things have now fallen in place. We can be a little more sanguine about the prospects of interest rates hardening as well as the crude going up. So I think that bodes well for the Indian mid caps, and relatively they are way better valued today, as in way more reasonable. So I think 2019 will definitely augur well, much better than 2018.
In 2018, especially in the late leg of 2018, we saw global scare. And it was a scary sell-off in Dow, a huge meltdown in some of the so-called halo stocks, the FANG stocks.
Yeah.
So far, we managed to survive the first hit, the first storm. But if this is a recurring unwinding or long unwinding, emerging markets like India will also get hit hard.
Right, sir. It's surprising, definitely. But I would say 2019 is going to be more a year of mean reversion than anything else. I think there was a huge, since 2009 bottom, American markets have had a huge outperformance to the world market. I mean, global market cap moved from $25 trillion to $85 trillion over a span of a decade. And the biggest contributor to that was the US market. Emerging market actually relatively underperformed significantly, and this gap between the developed market to emerging markets had reached a really wide point sometime last year, and that I think is reversing. So that is one of the reasons why we did not see a sell-off, even though nearly $1 trillion were wiped off just from the FANG stocks in US. So I think because FIIs have been sellers in our market since last 2 years. It's not a phenomenon of last 3 months, 6 months or something like that. So we have constantly been going down in weightage. Our market cap probably peaked at around 2.5 trillion and came down to 1.8 trillion. So we have also seen quite a bit of wealth erosion, and that is why today I'm much less worried about a global crisis setting off or some kind of a contagion which can make our markets collapse. I don't think we are facing that kind of a scenario today.
Okay, in markets we have to look forward, but I'll look back, and not look back for last 1 year, but last 2 years. 2017, the big year for fund managers, the big year for small cap investors. 80% of the market went higher. 2018, 18% of the market either went lower or it remained stable. What is in store for 2019?
You said it right there. In 2018, one of the studies that we did, more than 50% of the stocks fell, more than 50%. In that kind of a scenario, I don't think your portfolio can be, too much different than that. But enter 2019, there are many opportunities available for you to invest, and those risks where there were unreasonable valuations or unreasonable expectations, those have been taken out of the market, and now there are good set of companies available where there can be significant returns made over the next 2-3 year period. It might not be immediately in 2019, because some of the concerns are real. It's not like without a reason that these stocks have come off. There are good reasons. So, but that is where the opportunity lies. But opportunity is dressed in overalls and looks like hard work.
Are you able to find enough businesses which can give a potential earnings growth of 20 to 25% for next 2 or 3 years? And are those businesses available reasonably now?
Yeah, so let me the kind of buckets that we have. Is there an opportunity in the market today? There is an opportunity. What are the kind of opportunities available? So what we look for is a good business, good valuation, reasonable valuation, and a business tailwind. Now, it is very difficult to find a combination of all these three things present. So that definitely is very, very minuscule. But at the same time, if you were to take in, let's say there's a little bit of a cyclical headwind in the business, or there are some with structural headwind also, then if you are willing to look at those companies, then there's a bucket of and a pool of companies available where you can, if you stretch your horizon into 3 and 5 years of investment, then you can make good money over there. But you will have to live through next 12 months where the problems are still, still in the transition phase of turning around. For example, I mean, if I just to put some context to it, so PSU banks or real estate developers, they are going through some real tough times. Those are structural issues. But valuations are not an issue over there. It's only an issue of whether and if the sentiment will revive, the business tailwinds will come back. There is going to be a big supply crunch for sure. The number of players are going to be whittled down dramatically in real estate. So that's the positive.
So are you happy to buy a real estate stock? Do you own a real estate stock?
No, I don't own any. And only thing I'm saying is that's a bucket which requires more than 5 years horizon. Then if you look at something that has more cyclical business headwind, then I think over there your horizon can be 3 to 5 years and you can still make good kind of money. And managing public funds, it is sometimes we face challenges having a 10-year kind of a horizon. So we have to look at 3 to 5 years. So over there I would be more willing to buy a company which has some cyclical headwind going on and which can be corrected by, let's say, the raw material prices coming down, or let's say some amount of stimulus being given to the economy can lead to a spurt in growth. Those kind of situations are much more is more clear and present opportunity for us today.
Okay, so if we talk about your portfolio positioning, Jan 2018 versus Jan 2019, how many stocks have vanished? How many stocks have entered? And in terms of an aggregate approach, is there anything new and different, or it is extension of same?
No, I think, I don't know if you remember, but we spoke about it last time. So there are stocks which are priced to perfection, and especially though some of them are on the consumption side. So we are out of stocks that were priced to perfection. They are fantastic companies, business tailwind, everything is going in favor. But there is no room for error over there. High quality, high performance, highly valued. So the money has been chasing with very, very few ideas in this market, and those few ideas, because the ideas are few, have been really, really outpriced now. Now, as long as the business tailwind continues, the valuations can sustain. But I think there is a real risk over there of a significant underperformance with a 3-year point of view.
We've seen that in iShares. We started seeing that in a page. I think you're referring to pretty much the same obvious.
Yes, that is the pool of companies that I'm referring to. No one particular name, but yeah, that is the kind of thing. I mean, whether it is Page or iShares, or even for that matter, Britannia or
Ramdev
VIP.
Agrawal told me one thing, which is that महंगा रोए एक बार सस्ता रोए बार बार. We are always trying to find something very cheap, but it doesn't work.
No, it's not like we are looking for absolutely, we are not going down the junk road, but we are at the same time, Infosys can have 10 years of underperformance, Hindustan Unilever can have 10 years of underperformance. So you better be clear about what you are buying, and I think the risks are real in terms of underperformance over the next 3 to 5 years kind of a view. You cannot, that any long-term investors horizon also, that is a risk.
Okay. So you've been bullish on private banks, you've been bullish on select chemical names, you've been bullish on select retail stock fashion names. Have those themes extended themselves for 2019?
So, Private banks definitely the theme continues, but probably now some of the larger or the retail banks are not the ones to be focused on. Corporate banks are better placed. I think that is where surprise possibility is there in terms of earnings, as well as the comfort is there in terms of valuation. So larger private corporate banks, or for that matter smaller private regional banks also, they provide a very good risk to reward with a 5-year point of view. If the capex cycle, the corporate cycle was to revive, and I think that should revive, whether it is in the next 6 months or next 18 months is the only question. And that is definitely a fertile area to look at.
You don't think corporate banks is becoming like a consensus trade? Or maybe I'm speaking to all the smart guys who are bullish on corporate banks. So I don't know what is this a coincidence, or is this a consensus trade now?
No, so consensus or not, you have to look at the price performance, and you have to look at how much of the ownership is with the institutions. And if you believe that the price performance has been fantastic, then I think the performance hasn't even started yet. Honestly speaking, they are still available. These banks are doing sub 1% ROA. I think over the next 3 to 4 years, the ROAs will move from 0.7, 0.8 to 1.2, 1.3, and with some bit of leverage, the ROEs can move beyond 15%. In that kind of a scenario, all these banks that are quoting between 1 and 2 can quote anywhere between 2 and 3. So I think, I mean, we are at the beginning of the story. We shouldn't be worried about consensus at this point of time. It's a large pool. FIIs have been selling, and I don't see us being in an overcrowded trade by any stretch of imagination.
You know, you've earned this reputation of being the pharma expert on the stock market. When it comes to pharma, you know, we look up to you. We look for your thoughts. When you see a experience like Sun Pharma in 2018, it just shakes you. It shakes you that here is the bluest of the blue chip company where corporate governance standards have been raised for a sector and for an industry where debt is not a problem. Growth may be challenging, but they've never had a debt problem. What does that speak for the sector?
So I think this doesn't speak for the sector per se. I think it's a company specific issue. The sector issues were definitely more on the FDA front, and I think those are behind us. The corporate governance issues, I don't think they were completely unknown to the market. It's only that they are out in the public domain today, and they probably didn't matter when you were a small company. Today when you are in trillions of rupees of market cap, they matter a lot more, because all the global FIIs have taken an exposure to your stock. So I think there is no choice but to get your act together, clean up the books. And you are right. So they have a issue of their net debt they don't have, but at the same time, the cash in US and the cash in India, the cash in US and the debt in India. So they are not able to.
It's not matching.
Yeah, it's not matching. So they have a unique situation where they will have to probably get out of this mess in some way, but I don't think it reflects on the sector per se. It reflects more on the company.
We started with John Bogle, but let's go back to our favorite investor, Warren Buffett. We love to quote him, we love to talk about him. I wonder if he has to start charging IPs for his
he should charge a royalty.
He'll be a richer man by $1 billion every year.
For sure.
He pretty much is alluding to what you referred to, that you have to buy good businesses when there is a temporary slowdown or news is bad. Where else do you see this kind of an thesis getting played out?
So one space where 3-4 years of a bad period is coming to an end, I believe, is agri inputs side. Agri has been in a distress, and it's more because of agri prices being down than anything else. The global cycle also was on a slowdown since last 3 years, and I think over here there is a very good possibility that over the next 1 to 2 years there will be a pickup. The local government...
Despite what data we are getting from rural India?
No, so because there is so much distress, that is when governments will be forced to take action. And when government take action, it will result. I mean, you want to be positioned for it today.
Of course. Because the puck is going to move.
Correct. So because there is distress today, there is no choice but the agri prices to move up over the next 12 to 18 months. And finally, this is a cycle. If a farmer is not getting good realization for its crop, he'll move to another crop that gives him better realization. So that will eventually create shortage in the other crop, and that will make the prices move up. So I think cyclically, from agri prices point of view, we're close to a bottom, and we should move up in the next 12 to 24 months, and that is the local cycle. But even globally also, I think the commentary of the large chemical companies has now started being positive, and they have started witnessing growth, which had come down to close to zero. Now they are talking about 5-7% kind of growth. So that the confluence of local and global cycle picking up together, that should play out in the agri input side, and we prefer agrochemicals over other inputs.